Hello everyone. Do you know that there are two ETFs that if you could simply hold to achieve both diversification and consistent annually growth consistently? These two ETFs are very suitable to everyone who wants to grow their wealth consistently without monitoring the stock market. Historically, their average growth per year is more than 10%. They manage to easily beat the inflation, bank interest rate, or even CPF. Hello everyone, I'm Jay from JM Investment Journal. For those who are the first timer here, this channel is to record my investment journal on long-term investing and cash secured put strategy to retire myself early, so I could enjoy my time with my family. Please subscribe our channel, turn on the notification bell if you would like to know my strategy to retire myself early in stock market. Our aim for this video is to look for ETF combination that can give us the following. Number one, diversification into most of the sector. First, let's talk about diversification. One of the common misconceptions about diversification is to profit from various sectors using sector rotation. It is still true, but in fact, diversification is to protect our portfolio and capital. So our portfolio or capital will not bust if one of the stock is heavily impacted by the news. It is about risk control. In 2020, because of the COVID-19 outbreak, technology, growth and speculative stocks had a very nice bull run since March 2020. However, most of the value stocks such as finance, industry, energy, and materials were struggling. But in 2021, after the vaccine is released, everyone anticipated the economy will be recovering, inflation will be higher, Fed will be slowly tightening the money policy. Consequently, the money flows from technology or speculative stocks into value stocks again. The money flows from one sector to another sector is called sector rotation. If your portfolio is too heavy on value stocks, you could miss a nice run last year. If your portfolio is too heavy on growth stock, most likely your portfolio is still not recovering today. Here, the ETF combination that I'm going to introduce will benefit us from the bull run of both growth stocks and value stocks. Does not matter where the money flows between the sectors. Number two, consistently grow for capital gain with average annual return of around 10%. Why 10%? Let us look on the compound interest calculator. If we start with 5,000 capital with monthly deposit of $500, in 10 years, our capital will grow to around $100,000. In 20 years, we will have around $377,000. If our monthly deposit is $1,000 instead, we will grow our capital to $200,000 in 10 years and $720,000 in 20 years respectively. Let us start with the ETF, then focusing on value stocks. Vanguard Dividend Appreciation ETF, the ticker is VIG. VIG is designed to track the performance of Nasdaq US Dividend Achievers Select Index or DVG. To be included in DVG, the company needs to have at least 10 consecutive years of increasing annual regular dividend payments. Most value stocks companies pay dividends. In order to increase their annual regular dividend payments or distribution per unit, they need to make consistent or increasing net profit. Sometimes, because of the earning growth or the share buyback, we can also enjoy the capital gain from the value stock. Therefore, VIG is the ETF that could let us enjoy both dividend and capital gain at the same time. First, look on its sector weightings. Technology is only 14.8%. Other sectors, such as financial services, industrials, and consumer cyclical, are considered value stocks with the highest weightage in VIG. These value stocks are also the stocks that could benefit from the economic recovery or higher inflation rate. If we further look on its top 10 holdings, most of the stocks are very famous. JPM is one of the biggest American bank. J&J and UNH are both leaders in the healthcare sector. Microsoft is my favorite technology giant stock. Walmart, Procter & Gamble, and Coca-Cola are the giants under consumer defensive sector. Visa provides financial services globally. Home Depot is the largest home improvement retailer in US. Comcast is a company that provides telecommunication service in US. The top 10 holdings consist of around 31.43% of VIG. Compared to DIA or SPDR, Dow Jones Industrial Average ETF Trust, the ETF that tracks Dow Jones 30, it has a slightly higher weighting percentage in technology, around 16.9%, and its top 10 holdings consist of 51.64% of the ETF. I would prefer lower percentage of top 10 holding, so the volatility will be lower. I also prefer VIG as it has J&J and UNH. My Moomoo account is holding Thermo Fisher Scientific. Thus, VIG could complement my portfolio with the other two giants in the healthcare sectors. Next, how about the performance? Most of us may think that value stock with paying dividend will have lower annual growth, right? As we are now focusing on the long-term investing, we will focus on 3, 5, and 10 years return. You may surprise that VIG average return for 3 year, 5 year, and 10 years are 15.49%, 14.82%, and 12.54% respectively. If we compare to DIA, the average return for 3 years is lower than VIG. Both VIG and DIA have similar annual return for 5 year and 10 year. Please note that higher average annual return does not mean that the ETF is better than the another. It is an average. Thus, in some years, VIG outperformed DIA. In other years, DIA outperformed VIG. Even if we compare VIG to SPY, the long-term return for VIG is around 1 to 2% lower than the SPY. But SPY has a heavier weightage on the technology, around 23.48%. Here, I plot a graph compare their average return for your reference. These are some of the additional info on VIG. VIG net assets are 67.23 billion, a huge asset, even bigger than the DIA. The current dividend yield is 1.59%. The expense ratio or the fee is only 0.06%, which can be paid off by the dividend yield easily. The beta for 5 years is only 0.86. Low volatility with more than 10 to 15% annual return. Amazing, right? This is the summary for the DIA. It has a higher expense ratio of 0.16%, but still payable by the dividend yield. This is the summary table to compare VIG, DIA, and SPY for your reference. Before I continue to the next ETF, I hope you learned something new here, as we really spend a lot of time to deliver the best to you. Plus, we are going to prepare more videos to help you to kickstart your investing journey. I hope you could click the like button to motivate us more. If you have not subscribed to our channel, please click on the subscribe button and turn on the notification bell to get our latest updates. If you think that this video could help others, please feel free to share it too. Next, I'm going to introduce an ETF that is focusing on technology sector. In my opinion, technology stock is a must-have in everyone's portfolio, as technology is always creating future, and the stock market is about the future too. In addition, technology companies generally only require little capital expenditure to grow and maintain their competitive advantage. Value companies, such as those in material industry sectors, require much higher capital investment in order to expand their business. Moreover, the companies in the technology sectors are much easier to create story, and story is always give investor hope or hype to buy the company stocks. For example, cloud services, artificial intelligence, 5G, self-driving car, VR technology, drone, and a lot more. These stories could easily spike the technology stock price out. When we talk about technology ETF, QQQ will be flashed into most of the investors' mind. QQQ is an ETF that tracks the Nasdaq 100 index. In fact, if we look on its sector weighting, technology is only 44.42%. If we combine the communication services such as Google, Facebook, Netflix, the weightings are around 64%. QQQ also has the companies in consumer cyclical and consumer defensive sectors. For example, PepsiCo, Costco, Starbucks, and Booking Holdings are one of the QQQ components. I'm not going to talk about QQQ today. I would like to introduce VGT, Vanguard Information Technology Index Fund ETF. VGT tracks the performance of a benchmark index that measures the investment return of stocks in the information technology sector. Its technology sector's allocation is as high as 88.14%. The second biggest sector is financial services, such as Visa, MasterCard, and PayPal. These three companies are also in the fintech technology that is part of the innovative technology. Thus, if we just want to invest in the ETF that is focusing on technology, VGT is a better choice. Top 10 holdings of VGT are all famous big cap technology or fintech companies. Apple, Microsoft, Adobe, and Cisco are the big technology or IT companies. MasterCard and Visa are in the fintech technology. NVIDIA and Intel are the big semiconductor companies. Salesforce is an American cloud-based software company. The top 10 holdings consist of 56.44% of total assets. Next, how about the performance? Amazingly, the average return of VGT for 3-year, 5-year, and 10-year are 29.45%, 28.22%, and 20.15% respectively. VGT has a higher annual return compared to QQQ. Here, I plot a chart to compare the average return of VGT against QQQ and SPY. Let us look on the additional information on VGT. The net assets are 47.49 billion. Yield is low, 0.75%. This is expected as technology companies are mainly growth companies that mostly will use the profit for further expansion. Interestingly, despite of high annual average return, its beta is only 1.09. The expense ratio is also low. It is only 0.1% and payable by the yield itself. How about QQQ? Its net assets are far above the VGT. It has a high expense ratio of 0.2%, but it is still payable by the yield. This is the summary table. In February and March 2021, technology sector had a retracement of around 12 to 14% because of the surge of bond yield. How is the performance of VGT? From the chart, it already broke the all-time high and managed to recover from the dip. This is because VGT holdings are mainly consist of big cap companies with consistent revenue and profit growth, such as Apple, Microsoft, and PayPal. By contrast, ARKK Innovation Fund is still not recovering. This is because ARKK holds quite a number of speculative stocks which are not profitable yet. Thus, they are most susceptible to the higher interest rate environment. In my opinion, ARKK is the best speculative ETF that could be also part of the portfolio, which can further complement to VIG and VGT. I will address this in the future video. What are your favorite ETF? Please share with us in the comment below. This is the summary for VIG and VGT. We could see that they could complement to each other with a good 10 years average return. Do you like the content of this video? There are many interesting combinations that we can make using different types of ETF. Let me know if you would like to know more the ETF that could retire us early. Then I shall prepare more videos on this topic. Thank you very much and see you in the next video.